Hello, everyone. This is Lincoln Anderson. I'm your host today for the first ever webinar for the Oklahoma Central Financial Planning Department. Now, we have had lots of webinars in the past here that hopefully some of you have attended, but we are excited about this one. Again, my name's Lincoln Anderson, and I have been in charge of the Financial Planning Department here for about a year. It's existed for about 9 years, and that's part of my 18 total years of experience. But today, I'm not the speaker. We have a speaker who has more than double that amount of experience, who is going to be sharing his expertise with us. But before I get into that, let me start with a little housekeeping. So the first thing, especially for those of you that have been on one of our webinars in the past, normally we have a chat function. Unfortunately, today we can't use the chat. The things that we'll be talking about fall over into the investment arena at times, and so we're under a different set of regulations and we can't use the chat. The good news is we do still have the questions function. So if you have a question during the presentation, type it in, and at the end, time permitting, we'll address as many of those questions as we can, and any that we don't get to, I will follow up with whoever asked the questions in the next few days. So keep that in mind. There's no chat, but take full advantage of that questions function. Now, the next thing is, by far the most popular question in any webinar is there going to be a recording? So let me answer that now. Yes, we will have a recording for you. So if you miss anything or if you want to review it, that recording will be available very soon. I'm sure we'll still get asked 16 times by people that showed up late, but that's okay. There will be a replay. Keep that in mind. So at this point, let me introduce our speaker. Our speaker is going to be Waldine Wall. He is the Vice President of Advanced Markets and Solutions at Allianz Life. He has more than 40 years of total experience, and for the last 18 years at Allianz, he's focused primarily on tax planning and strategy, also retirement income, which is our subject for today, and then legacy transfer planning as well. He's a chartered financial consultant, and we're very lucky to have him here. Waldine, I want to give you a warm virtual welcome to Tulsa. Thanks for being here.
Thank you, Lincoln. It's great to be here. Yeah, we're doing a lot of things virtually these days, so I guess that's what we're doing.
You bet, you bet. Well, we're excited about it, so I'm going to turn the reins over to you and let you get cranked up.
All right, let me make myself the presenter here. Got it? Show my screen. And let me know if this doesn't work out the way we thought it would. So.
Yep, we're seeing your screen, but not the presentation yet.
Yeah. Well, I'm going to do this. I'm going to make you the presenter again, because then I had a show my screen button that was alive. Wow. Presenter. Well, this is interesting. Just give me a second here. Oh. I'm struggling here. Oh, show my screen. Okay, I've got a show my screen button. So I'm trying to okay, how does it now? Tell me if can you see that?
Yep, success.
All right, fantastic. Woof, crazy. All right, today we're going to talk about creating income in retirement. And I need to preface this just a little bit. When you look at your situation, and you should probably have Lincoln helping you with that, but when you look at your situation, at some level, we have to figure out whether you are what I would say marginally ready or independently wealthy. Now, I don't mean independently wealthy like a Bill Gates, or a Elon Musk is. I'm just saying from the perspective of retirement income, from the point of, am I going to run out of money? Do I have enough? We kind of have to make some judgment in there in terms of, are you marginally ready? So by marginally ready, what I mean is you're probably going to be okay. You've built assets, right? You maybe controlled your budget. Maybe you have a small pension and Social Security. And so, just on a preliminary basis, it seems like you're all right. But nonetheless, you need for things to kind of go well for you. If things really go crazy, you might be in trouble, right? So those folks are marginally ready. That's me. I'm going to be marginally ready when I go into retirement. I'm not going to be independently wealthy. Now, the reason I mention this is because if you are marginally ready, you will need to create an income strategy to make sure that you don't run out of money, to make sure that you have the income you need. And one of the things we're going to talk about today is why or how the income phase of life is completely different than the accumulation phase, right? So that's going to be part of our discussion. What does the income phase look like? And then what are the strategies that we can implement to make sure that we don't run out of money, so that if the market doesn't cooperate, we're still going to not run out of money, right? So let me just say one more thing here. We don't know what, somebody goes into retirement today, and let's say we plan for 25 years, right? That's kind of a reasonable length of time. Maybe we should be planning for 30 years. In the last 25 years, I'd like you just to think about this with me. In the last 25 years, we have had two major black swan events that have really disrupted things. So number one, way back then, we had 9/11. Remember 9/11? Unexpected, didn't see it coming, and it really, really changed the dynamics of investment. I think maybe markets were a little frothy at that time. 9/11 hits, and now we go into a decline and all kinds of other problems. But we didn't see it coming, and boom, there it was, and everything was kind of, messed up. Now, there's a second black swan event that I'd like to mention, and it's the pandemic. We didn't see it coming. Nobody really knew how big this thing was going to be or could be. It was global in nature, right? The pandemic is why we had the difficult year last year. So when the pandemic hit, what the government did, because again, it's hard to know exactly what the future of this thing is, they just flooded the system with money, right? They just opened the checkbook and borrowed like crazy to pour money into the economy just to keep things alive. Well, what that resulted in was inflation, right? A lot of that money probably went to folks that didn't need it. And again, I'm not suggesting they could have done this a different way or a better way. I'm just saying this is the reality of it. There was a lot of money that went into the system, went into the hands of folks that really didn't need it. And so we saw housing prices go way up, right? We saw equity values go way up. We saw inflation. Well, how do you kill inflation? We gotta raise interest rates. Well, what does that do? It puts the markets into a tailspin and creates other economic problems. So in the last 25 years, two major black swan events that really have created difficulty. And then we've had other things happen too, right? We had the subprime mortgage crisis, remember that? Where we lost 50% of the S&P declined by 50% at one point. Okay, so that's just the last 25 years. So what makes you think that the next 25 years won't be the same? Why would the next 25 years just cooperate as if there's no problems, right? So that's why when we go into a retirement, and most of us will kind of turn our back on our paycheck, right? And now all the money we have is all the money we're going to have. We have to have a strategy to make sure we can navigate this. So I want to start with a case study, and maybe you can relate to this. But this case study, Mary and Mark, okay, they're going to go into retirement in 5 years, right? They've tried to manage their money well. They've basically had it in the S&P 500, so they've been happy. Last, few, decade or so has been really good. And they think they'll have somewhere around $975,000 when they go into retirement at age 65. At age 65, and they need that money to generate $50,000 a year. Now they're assuming a 6% return. We'll talk about that a little bit. They're assuming a 6% return. They need $50,000 a year. They want to be able to adjust that for inflation, 2% a year. And they've done a spread. They put a spreadsheet together, right? 6% a year, $50,000 increasing by 2% a year coming out. And their calculations would say they're going to have $390,000 left over after 30 years. So this to them, they feel pretty good about this, right? But the real question is, are they thinking about this in a way that works, right? So this is their spreadsheet. We start at $975,000, and actually the account grows initially as we start taking out money, but as our draw increases, all of a sudden we turn the corner, down we go. But in 30 years, we still should have $390,000. So the question becomes, is this reasonable? This is really, really important. Most folks think about generating retirement income from their savings this way. They think that income is the opposite of accumulation. During accumulation, I just put the money in. During retirement, I'll just take the money out. And so they do a calculation like this, and it seems reasonable, right? The problem is income is different than accumulation. When you're accumulating money, you don't really care when the good years happen and when the bad years happen. You just absorb them, you keep putting money in, and what's important is what's there at the end. When you get into income, if you simply withdraw, now you run into the possibility of being completely wrong on your assumptions, because when the good years happen and when the difficult years happen, really important. If your investments are underperforming initially, maybe for the first third of retirement, and you're pulling out income, you are locking in this underperformance every time you take an income check. And so now when things start to turn around and look good, you don't have enough money to make it right. So we call this the sequence of returns risk. So let me just show you again why many folks are going into retirement with much more risk than they should be. If we went back to 1992 and said, I'd like to get a 7% return, okay? In 1992, we could get that 7% return with just cash and bonds. So the volatility that we would need to absorb to get the 7% return would be very low because we're just using cash and bonds. If we move to 2007, what we find is that since interest rates have came down so much, we can no longer get the 7% return just by using cash and bonds. It doesn't work. Now, in the best case scenario, we need about half of our money in volatile things, stocks, large cap stocks, small cap stocks, foreign stocks. And we have a calculator that said, what was the most efficient way of blending all of this so you absorb minimum risk while getting the return, while hopefully getting the return that you need, right? But so now we have the possibility of getting a 7% return, but the standard deviation, the volatility, the risk went way up because again, only half of our money is in fixed income or bonds, right? Because interest rates have come down. Now in 2022, and we haven't updated this for right now for 2023, but in 2022, if you wanted to get a 7% return, you could only have about 11% of your money in cash and fixed income. Actually, 7% of your money in fixed income. The rest has to be in equities because interest rates were so low. So when you do your financial planning, if you think your target is like 7% a year, you're basically going to have to be fully invested in equities in order to have a chance at getting that kind of return, and your risk goes way up. And so the question obviously is that the kind of risk someone should be exposed to as they move into retirement, right? And obviously what has happened in, if you were exposed to that kind of risk, hoping to get the return you need, you're going to take a big step back here. You're going to lose a year while inflation expands. So you're getting hit on both sides of this. One, the market isn't cooperating, and two, the cost of living is going up. So when we get to retirement, typically what we want to do is get the return we need while taking minimum amount of risk, right? So we go back to the example that I chose with this couple going into retirement. If we would invest their money such that they have a possibility of getting 6% return, so it can't be in all in cash, right? It can't be in bonds, just in bonds and cash, because that's never going to get them 6%. They only have a 50% chance of success, 48% chance of success, right? So a lot of times what people will do is they'll run the spreadsheet, they'll think they're okay, but when they actually invest the money to get the return that they need, now the risk in the market could make them wrong. So let's look at this another way. Here is the line that shows a 6% return in retirement, right? Nice and smooth. That line is not possible. There is no line like this for 6% return. The only time you get a line like this is when, again, your money is in long-term bonds, possibly, right? Otherwise, and we're not getting 6% right now. And I don't know, the way the economy looks to be moving, it looks like interest rates might be going down now because the economy's in a bit of trouble. So 6% per year might be a good target, but you're not going to create that with a line like this because you're going to have to invest for it. Now, when I went through my 10,000 market risk possibilities, I was looking for one that would end up with exactly 6% per year over 30 years, and this one popped up. So the standard deviation is about 11.94, and this is what it would have taken to get the 6%, right? So down sometimes, up sometimes, flat sometimes, up, down, down, up, really down, up, and so forth. And we come out exactly at 6%. Now, one of the problems with this kind of a study is just because you have the possibility of getting 6% doesn't mean you actually will, right? So, but in this case, I wanted to make it work out that way. Now, let's look at this another way, right? So here's another line. We have the pink line and we have the blue line. Now, both of them end up with a 6% return, right? But the blue line is the pink line reversed. So you can see how the pink line doesn't have phenomenal returns here at the end. It had great returns at the beginning, but not phenomenal returns at the end. In this other case, the blue line has, marginal returns at the beginning, and then at the end it has the wonderful returns. Both end up at 6%. So the question is, which scenario do we plan for? Well, the thing is, you can hope for the pink line, but you should plan for the blue line, right? So this is where now the four income strategies come into play. What happens when we get the pink line? What happens when we get the blue line? And we're going to look at these four different scenarios. So this is going to be a little shocking, but this is exactly how it works. So the first strategy is simply withdrawing money. This is what most people do. They have money in their retirement plans, and they're just taking the income. They're withdrawing the income that they need every month or every year, goes into their checking account. It kind of runs on automatic. Every year they might increase it for inflation. And the thought is that, well, I'll be okay, or the hope is that I'll be okay. So if we had the pink line, we would indeed be okay. We'd actually end up with more money than we started with. If we ran into the blue line in terms of investing our money to get a 6% return, and of course the blue line underperformed at the beginning, we reduce the account to such an extent that even when it picks up, there's not enough left. And so we run out of money here in 24 years. Isn't that a crazy difference? Positive returns at the beginning of the cycle of the retirement, help us cruise to the end. Difficult returns at the beginning can really, really crush us. So again, in both of these examples, we're investing for a 6% return, but when the markets are good and when they're not so good is critically important when we take money out. We don't see that when we're putting money in, but when we take money out, big, big deal. I just think this is very difficult, right? Most people don't realize that if they're marginally ready when they go into retirement, they have got to control risk. If you're independently wealthy, you can say, well, what does it really matter, right? So just a simple withdrawal like this gives you maximum exposure to the sequence of returns risk. Now, the second way of generating income, and I'd really like you to pay attention to this. This is a good one. This is a way of generating income where you're not going to run out of money. If you have the pink line, you're not going to run out. If you have the blue line, you're not going to run out. So we're calling this a time-based strategy or a life expectancy strategy. So in this planning example, we're planning for a 30-year time horizon, right? So what we're going to do is we're going to take 1/30th of the account in the first year, 1/29th of the account in the second year, and we're just going to keep that going, 1/28th, 1/27th, 1/26th, and you won't run out of money. Now, the problem is you may not quite get the income that you need, right? So planning for 30 years, if you just take the amount of money you're going to have saved up and take 1/30th, that's not a ton of money. And then as the life expectancy shortens, your withdrawal amount changes. But as you can see, so here's the IRA value with the pink line, and here's the IRA value with the blue line. They both last. So the pink line, because the markets are good at the beginning, the investments are good at the beginning, just creates a lot of capital. And then our withdrawals, get bigger because the account is done better. The blue line also lasts. Now, this is where this other graph comes into play, the income amount graph. Both of these start with the same amount. Now, we wanted $50,000 here, but 1/30th is not 50, right? So the problem here is that we're starting with less than we wanted. And the income amount under the pink scenario grows quickly, and we're ready to go. We're doing well. The income amount on the blue scenario holds its own and gradually increases. And at the end, when we get the good years under the blue scenario, we get more than we need. Okay, the reason I like this though is because there's a governor on the system. We have a plan. Now, most people will say, well, that's great. You didn't run out of money, but I really didn't get the money that I wanted on the front end. I get it. I get it. Maybe the message here is that we don't have quite enough money, or maybe we should work a year longer, or something like that. But anyway, this is a strategy that can help us make sure, no matter kind of what the markets do, that we don't run out of money. I'm targeting this kind of a strategy for my own retirement, right? So I have a retirement income goal. I'm getting Social Security. I will be getting Social Security, I should say, along with my wife. I have a very small pension that's coming in, and then the rest is going to be created with my retirement plan. One of the ways I can do that to make sure that I don't run out of money is using a strategy like this. All right, so that's number 2. I hope I'm explaining this in an understandable way. So high probability that your money will last, but you may not start with as much as you were hoping for. Now, this is number 3. This is a very interesting one too. What we're going to do here, I hope this is not getting too complicated, but the first thing we're gonna do is we're gonna take this couple that we're kind of using as a case study. We're gonna start with the $975,000 that they're supposed to have in retirement. And we're going to ask the question, what kind of return do I need in order to make this plan work? What kind of a return every year do I need in order to make this plan work? And the answer is 5.36%. Okay, so now what we're going to do is we're going to draw that line here. This is how the 5.36% line would work. And boom, we're out of money in 30 years, just what we wanted to. Now, the second step is we're going to withdraw what we need. So we're going to start with a $50,000 withdrawal, And if at the end of the year, our values are below the green line, we're going to take less next year, right? So we're going to take less next year. We're going to leave more money in the account to recover. And then when the account balance gets above the green line, now we're back on schedule, right? So how much are we going to reduce the income by? If we're behind schedule, we're going to reduce it by 10%. So this is an arbitrary number, but this is the number we're hoping will work. So you can see here, in the first year, we take out $50,000. At the end of the first year, the account value is below the benchmark, the green line. And so now next year, we're not going to take out 50, we're going to reduce it by 10%. Hopefully, again, leaving more money in the account to recover. Now, if we get the returns from the pink line quickly, we've got no problems, right? We had to reduce our income once, maybe twice, and then we're good to go. Now, the blue line is very interesting, right? So we had to reduce our income periodically. Every time it goes below the green line, we're going to reduce it by 10%. But look, it did a pretty good job in keeping us close to the target. So we got more money more frequently. We had to reduce occasionally. The problem here was that taking 10% less wasn't quite enough, and we ran out of money in 27 years. So it lasted longer than 24 years, but the 10% reduction when we don't meet the objective wasn't quite enough. And so the good news is we start with the amount of money that we wanted. The bad news is we ran out, right? So those are three strategies to create income in retirement. And I would suggest that if you need to generate a 5% return on your money or a 6% return on your money in order to make your income goals, and you've run the spreadsheet and you think it's pretty good, you have to be very, very, very careful here, because you're not going to get a 6 or a 7% return with your money in the bank. So you have to invest it. Obviously, Lincoln is here to help you with that. But you have to have a strategy underneath this money so that you don't run out. Now, the fourth strategy is to use an annuity for part of that income. So an annuity creates a level of income that will not run out. So it's kind of a stabilizing factor. It's not affected by difficult markets. The income will be there as long as you are. It's stable, dependable, reliable. In some ways, it's kind of like Social Security, right? So it just makes your foundation bigger. But typically, a person doesn't generate all their income through an annuity and Social Security. There's still that element that is that is discretionary, right? That you have to develop some kind of a different strategy for. So the fourth strategy is what I had Mary and Mark do here is I had them put $400,000 into an income annuity, and that will generate. So they do it now at age 65, given the assumptions here. That will generate a little, that $25,552 a year, and that amount, we're assuming that amount will go up by 2% a year. So now the remaining money is what's going to be needed to generate the rest of their income. So what we did is we used just the annual withdrawal rate, for the rest, and we still ran out of money, but more of with the non-annuity income, we still ran out. but there's a base now. There's a second base of income over and above Social Security. So that situation is better if the blue line happens. We're only kind of worried about the blue line here, right? Because that's a real possibility and we want to protect ourselves. Now, here is that time-based strategy that I wanted to make sure you remembered, right? Where we take 1/30th the first year, 1/29th the second year. Now, what was the problem with that? Well, the problem was the blue line here again, we started with a fair amount less than what we wanted. By adding the annuity, so this peach colored line here is the annuity plus the blue line. The annuity plus the blue line. So the amount that we can start with goes up, which is what we wanted, and it kind of stabilizes everything, right? So this is the security of the annuity along with Social Security. It just stabilizes everything. In effect, it takes some of the excess on the back end and moves it to the front end. So this is a better solution. And again, Social Security and the annuity are there to stay in the worst case scenario. When we do that same thing with the income reduction strategy, so now we have the annuity that generates the income, we're still trying to create another income strategy with the rest of the money. We still have the same problems, right? So if we don't guess right on the amount of reduction we need when we're underperforming the benchmark, we're going to run out. But the annuity will never run out. Social Security will never run out. So I guess what I'm saying here is if you're not independently wealthy, you have to have some kind of an assessment that helps you understand what kind of risk you're exposed to, and you need a strategy. So final observations, evaluate your Social Security decisions. It may be that there's a better way of drawing Social Security that will improve your odds. Lincoln can help you with that. Number two, evaluate when you want to retire. This is always, a possibility. Nobody likes to think about it, but working longer is a genius thing, because when you work 1 year longer, not only do you have one more year to save, but you have one less year to draw down your capital, right? So you can make progress really quick there. Budget, evaluate your budget. Maybe there are considerations you should make there that can help in retirement. Carefully understand the risks that might be ahead. So as I turn this back over to Lincoln, and trying to figure out how to do that, I just want you to be encouraged that there's all kinds of adjustments that could be made, perhaps strategies that can be implemented, and Lincoln can help you with that. But this is a real burden of mine. I'm really concerned about people that are, marginally ready, going into retirement, and they don't have, a strategy. So Lincoln, I don't know if you can take the screen back, but I want to give it back to you.
All right, I will jump in here. And by the way, thank you very much for that presentation. It was clearly phenomenal, because I've never ever had a presentation before that didn't generate a single question. So obviously
that means we're in trouble, huh?
You explained it beautifully. I really like that pink line and the blue line. That contrast was very, very helpful there. Since we don't have any questions, we'll go on and start wrapping up. I've put on the screen my phone number there, 918-280-5211. That's my direct line here at the Brookside branch. If you lose track of that, no problem. Go to the Oklahoma Central Credit Union website. If you scroll down on the left side, there's a link that says financial planning. That will take you to the same information. I meet with people at every branch, wherever you're comfortable. So just call me, set an appointment. If you have individual questions, I can answer them over the phone, or we can get together in person. And I would love to do that. It's a free service that the credit union provides for members. So please take advantage of it. At that point, I guess that's pretty much it. So thank you all for attending. We really appreciate all of our members. We hope this was valuable for you. And also thank you very much to Waldine for sharing this excellent information. And we look forward to seeing all of you a couple more times this year as we continue this series. So I hope you all have a profitable day, and thank you very much for attending.